The pullback we've been seeing in crypto may be better understood through the lens of ownership transfer rather than traditional boom and bust dynamics that defined earlier crypto cycles. One of the defining features of the 24-25 period was the introduction of US spot ETFs, which opened the asset class to an entirely new cohort of investors. Unlike early adopters who navigated exchanges, custody solutions, and significant regulatory uncertainty, many ETF participants gained exposure through familiar brokerage platforms. While this broadened access and accelerated adoption, it also introduced a segment of investors whose conviction was largely tied to narrative momentum rather than deep understanding of the asset class. As markets corrected from their 2025 highs, many of these newer participants were tested for the first time. The result appears to have been a meaningful shakeout of weaker hands, with ownership increasingly migrating towards investors with longer term investment horizons and greater conviction in the underlying thesis. This process is a hallmark of healthy market maturation. Rather than representing a structural deterioration in demand, the correction may be facilitating a transfer of supply from shorter term participants to investors more willing to hold through volatility. At the same time, Bitcoin and ETH continue to evolve as asset classes. Institutional adoption has expanded significantly, market infrastructure has improved, and liquidity has deepened. These developments have contributed to a gradual decline in volatility over time. While crypto remains a volatile asset class, the magnitude of drawdowns has generally moderated as the market has matured and grown in size. This dynamic is particularly important when viewed through the framework of the 4 year cycle. Historically, the most attractive long term opportunities have emerged after periods of significant retracement and investor capitulation. Following the substantial declines already recorded from the 2025 highs, both Bitcoin and ETH have experienced corrections that would have been considered severe in most traditional asset classes. Yet, unlike previous cycles, the market today benefits from broader institutional participation, more sophisticated infrastructure, and significantly larger base of strategic holders. As a result, there is growing argument that the downside from current levels may be increasingly limited. This does not imply that volatility has disappeared or that further weakness is impossible. However, the combination of a stronger ownership base, declining volatility, improving market structure, and substantial corrections already realized suggests that much of the speculative excess has likely been removed. Viewed through this lens, the market may be approaching a phase where accumulation gradually replaces distribution. The focus shifts away from short term narrative driven flows and toward longer term positioning by investors who understand the role of digital assets within a diversified portfolio. For Bitcoin, this reinforces its evolution towards a globally recognized alternative store of value and portfolio diversification tool. For Ethereum, it highlights continued confidence in the long term growth of blockchain based financial infrastructure and decentralized applications. While no market cycle unfolds exactly as the last, the current backdrop increasingly resembles the later stages of a corrective process rather than the early stages of a new structural decline. If ownership has indeed migrated toward more informed and conviction driven investors, the foundation for the next phase of the cycle may already be taking shape.